All-in airfare pricing is a system where airlines must show the total price of a ticket up front, including base fare, taxes, fuel surcharges, and mandatory fees, instead of advertising only the base fare and adding costs later. In simple words, it means that the price you see is the price you pay, with no hidden surprises. Historically, airlines used to advertise very low base fares to attract customers, but these prices often excluded essential charges like airport taxes or baggage fees. As a result, the final price paid was much higher than what was initially advertised. Regulators, especially in Europe and North America, introduced all-in pricing rules in the 2000s to improve transparency and protect consumers. The European Union, for example, requires airlines to display the full price, while the U.S. Department of Transportation also mandates that advertised fares must include all government taxes and fees. Economically, all-in airfare pricing is about transparency and competition. When prices are clear and comparable, consumers can make better choices, and airlines compete more fairly. If one airline shows only the base fare while another shows the full cost, customers may be misled into thinking the first option is cheaper. By requiring all-in pricing, regulators reduce price obfuscation, where companies hide the true cost to attract buyers. This system also reflects a trade-off between mandatory costs and optional extras. All-in pricing requires airlines to include only the unavoidable charges. Optional extras, such as checked baggage, seat selection, or in-flight meals, can still be added later. This distinction allows airlines to keep offering low entry prices while being honest about the minimum cost of travel. An example makes this clear. Imagine an airline advertises a ticket from Paris to Rome for €50. Without all-in pricing, the customer might later discover airport taxes of €20, a fuel surcharge of €10, and security fees of €5, making the true cost €85. With all-in airfare pricing, the airline must show €85 as the upfront ticket price, while offering optional extras separately. The benefits are clear. Consumers face fewer hidden charges, competition is more transparent, and trust in the industry increases. On the other hand, some airlines argue that all-in pricing reduces their marketing flexibility, since they cannot advertise ultra-low teaser fares. They also claim that customers may not always understand which parts of the price are fixed and which are optional. A curiosity is that low-cost carriers, which often rely on add-on fees, have been some of the strongest critics of all-in pricing rules. They argue that their business model depends on separating the core fare from extras. Still, even they must comply with regulations in many markets, showing a realistic minimum cost while upselling optional services. To summarize, all-in airfare pricing is the requirement that airlines display the full, unavoidable cost of a ticket up front. It was introduced to improve transparency, reduce misleading advertising, and create fairer competition. While it limits marketing tricks, it benefits consumers by making prices easier to compare and more honest. Up above, I left you more videos so you can keep learning law. Remember to leave us a like and subscribe.